What if I told you that starting to invest this year could be the smartest financial decision you'll ever make, but only if you avoid the 7 deadly mistakes that destroy 90% of new investors? Stay with me, because by the end of this video, you'll have a bulletproof strategy that could potentially change your financial future forever. Here's the thing that nobody talks about when they give investing advice. Everyone assumes you should start investing the same way people did 10 years ago, but the investing landscape has completely transformed. The strategies that worked in 2016 or even 2020 might actually hurt you in today's market environment. I've been analyzing market data for over a decade, and I can tell you with absolute certainty that if I were starting my investing journey right now, I would do everything completely differently than I did back when I actually started. The tools are better, the opportunities are different, and frankly, the risks have evolved in ways most people don't understand. Let me paint you a picture of what most new investors do wrong. They open a brokerage account, maybe watch a few YouTube videos, and then immediately start buying individual stocks based on headlines or hot tips from social media. Within 6 months, they've either lost money or made a few lucky gains that give them false confidence. Sound familiar? This approach is financial suicide in today's market, and I'm going to show you exactly why. The first thing I would do if I were starting fresh today is completely ignore individual stock picking for at least the first 2 years. I know this sounds boring, and every finance influencer is going to tell you to buy the latest trending stock, but here's what they won't tell you. The average individual investor underperforms the market by about 3% annually, not because they're stupid, but because they're playing a game they don't understand with rules that are constantly changing. Instead, I would focus exclusively on building what I call the foundation portfolio. This isn't some revolutionary concept, but it's the most powerful wealth-building strategy that exists, and it's also the most ignored because it's not exciting enough for social media. Here's exactly what this foundation would look like. 60% of everything I invest would go into a total stock market index fund, not the S&P 500, not a growth fund, not some sector-specific ETF. A total market fund that owns literally thousands of companies across every industry and every size company in America. Why? Because when you buy a total market index fund, you're essentially betting on the entire American economy. You're saying that over the next 20 or 30 years, American businesses will continue to innovate, grow, and create value. Historically, this has been one of the safest bets you can make. The next 20% would go into international developed market funds. This gives me exposure to companies in Europe, Japan, Australia, and other stable economies. The reason this matters is diversification, but not the kind of diversification most people think about. Most people think diversification means owning different stocks. Real diversification means owning different economies, different currencies, and different regulatory environments. When the US market struggles, international markets often perform differently, and vice versa. Another 15% goes into emerging market funds. These are the faster growing economies like India, Brazil, and parts of Asia. They're riskier, but they also have higher growth potential. The key is keeping this allocation small enough that it won't destroy your portfolio if things go wrong. The final 5% is where things get interesting. This is what I call my future portfolio. Half of this goes into real estate investment trusts, which give me exposure to real estate without actually buying property. The other half goes into commodity funds or inflation-protected securities. Now here's the crucial part that separates successful investors from everyone else. I would automate absolutely everything. Every single dollar would be invested automatically on the same day every month, regardless of what the market is doing, regardless of what the news says, regardless of how I'm feeling about the economy. This is called dollar cost averaging, and it's probably the most powerful investment strategy that exists for regular people. When markets are high, your money buys fewer shares. When markets are low, your money buys more shares. Over time, this smooths out the volatility and removes emotion from your investment decisions. But here's where I would do something different from traditional advice. Instead of investing the same amount every month, I would invest a percentage of my income. If I make more money, I invest more. If I make less money, I invest less. This ensures that my investment rate grows with my income over time. The amount I would start with is whatever feels slightly uncomfortable but not painful. If you can easily invest $500 a month without thinking about it, you should probably be investing $600 or $700. The goal is to push yourself just enough that you notice the money going out, but not so much that it affects your ability to pay bills or enjoy life. Here's another critical element that most people completely ignore. I would never, and I mean never, check my investment accounts more than once per quarter. This might sound crazy in a world where you can check your portfolio balance on your phone every 5 seconds, but frequent checking is one of the fastest ways to destroy your long-term returns. When you check your investments daily or weekly, you start making emotional decisions. You see a bad day and want to sell. You see a good day and want to invest more. You read news about market crashes and start panicking. None of these behaviors lead to good investment outcomes. Instead, I would set up automatic investments and then literally forget about them for 3 months at a time. When I do check, I would only look at the overall trend, not the day-to-day movements. Now let's talk about the elephant in the room. What about all the exciting investment opportunities that everyone talks about? Individual stocks, cryptocurrency, trading options, real estate flipping, starting a business. Here's my controversial take. I would completely ignore all of these for the first 2 years. I know this sounds conservative and boring, but here's why this approach is actually radical. By spending your first 2 years building a solid foundation and learning how markets actually work, you're preparing yourself to make smarter decisions about riskier investments later. Most people do it backwards. They start with the risky, exciting stuff, lose money, get discouraged, and either quit investing entirely or spend years trying to recover from early mistakes. By starting with the boring stuff, you're building wealth and education simultaneously. After 2 years of consistent investing in diversified index funds, then and only then would I start exploring other opportunities. But even then, I would never allocate more than 10% of my total investment portfolio to speculative investments. Here's something else I would do differently. I would treat investment education like a part-time job. 1 hour every week, consistently, learning about investing, economics, and financial markets. Not from social media or random YouTube videos, but from actual books, research papers, and reputable financial institutions. The goal isn't to become a professional investor. The goal is to become educated enough to avoid scams, understand basic market principles, and make informed decisions about your financial future. I would also focus heavily on tax optimization from day one. This means maxing out any employer 401k, matching immediately, then using tax-advantaged accounts like IRAs before investing in regular taxable accounts. The tax savings alone can add hundreds of thousands of dollars to your long-term wealth. Most importantly, I would develop what I call investment discipline. This means having rules and sticking to them no matter what happens. No matter what your friends are investing in, no matter what some financial guru on social media is promising, no matter what the latest market trend looks like. Your rules are your protection against yourself and against a financial industry that makes money when you trade frequently and take unnecessary risks. If I were starting today, my only goal for the first 5 years would be consistency. Consistent monthly investments, consistent allocation percentages, consistent review schedule, consistent education routine. Boring consistency beats exciting inconsistency every single time in investing. The truth is, building wealth through investing isn't complicated, but it's also not easy. It requires patience in a world that rewards instant gratification, consistency in a world full of distractions, and discipline in a world that profits from your impulsive decisions. But here's what makes it all worth it. If you can follow this approach for 10 years, you'll likely have more investment knowledge and wealth than 90% of people who have been investing much longer, but without a clear strategy. The best time to start investing was 10 years ago. The second best time is right now, today, with a plan that actually works for the long term rather than just the next few months.